So thank you all for joining. Really happy to have all of you here and sincerely appreciate the turnout today. It's the 1st of June. We are 2 months away from 31st July, which is the deadline for ITR filing, as most of you know. Uh, so the goal is here to talk a little bit about capital gains and ITR season. And I know we've done a webinar in the last few months on capital gains and tax harvesting, but a lot of feedback has come in from people saying that they would appreciate a session on capital gains and how MProfit can help around this time, because I think everyone now is going to start filing their year-end returns for the last financial year. So we thought that even if there might be certain repetition compared to the last webinar, we'll do one more right now to make sure that the various different capital gain concepts and rules and MProfit features are fresh in everyone's minds, and we'd be happy to clarify any specific doubts with regards to MProfit and capital gains on this webinar. So without further ado, I'll get started with today's topic. It's going to be all about how MProfit can help with ITR season, and we'll talk a little bit about capital gains, how different asset classes are properly handled in MProfit from a capital gain standpoint. So let's get started now. So firstly, what are capital gains? And just for those of you who don't know, my name is Atik Shah. I am the Chief Business Officer of MProfit and one of the co-founders as well. I've spoken to some of you already from time to time, and for anyone who's new on this webinar, very warm welcome and hello, and I hope that we can connect in the coming weeks and months. I hope I am clearly audible now, and if there is any audio issue, please do let us know in the chat so that we can I can speak louder if required. So, firstly, what are capital gains? So everyone knows generally what capital gains are, but just to quickly summarize, capital gains are basically profits or losses earned from the sale of assets, such as property, stocks, mutual funds, bonds, and other investments that you have invested in from time to time. Uh, Capital gains have to be taxed in any given financial year for gains and losses that are booked in that particular financial year. And that is essentially why all of you are here today. Uh, Everyone will be filing their capital gains for the last financial year 23-24 in the next 2 months. And MProfit helps with capital gains on stocks, mutual funds, equity, debt, and hybrid, traded bonds, sovereign gold bonds, REITs, InvITs. So we cover a majority of listed assets from a capital gain standpoint, handling the various different capital gain nuances that need to be accounted for. There are various different rules that the income tax department has informed about that need to be followed, and these nuances are often tedious to compute when you are doing it individually. So either a CA is helping you, or you're using MProfit, or your CA is using MProfit directly. There are various different ways in which MProfit can help. So how are capital gains taxed? There are various different types of capital gain rules, and each asset class has its own set of rules. And today, what the agenda is going to be is we're going to be covering asset-wise what the different capital gain nuances are and how MProfit helps. So MProfit today provides capital gain reports, both summary reports and detailed reports for various different asset classes, as I just mentioned. We handle the various different capital gain nuances that need to be factored while filing your ITR. We also provide capital gain reports in formats that are compatible with different tax filing portals. The government ITR portal, for example, allows you to upload a Schedule 112A report, or you have ClearTax, Winman, Computax, other tax softwares that allow you to upload the capital gain reports to them. So MProfit provides reports that are compatible with these tax filing solutions as well. And we also then provide certain additional capital gain reports, such as unrealized reports, that give you your notional P&L. That is important from a tax harvesting standpoint, which isn't really the focus for most of you right now, because that generally happens at year end. So today we will focus more on capital gains. I'm going to now also share the MProfit application in my screen so that I can show you various different things that MProfit can help with. So just give me a second. So the first asset class we're going to talk about is stocks and equity mutual funds. Now, with stocks and equity mutual funds, I think most of you know that they are subject to both short-term and long-term capital gain taxation. And typically, the capital gain rules and the taxation slabs are also the same for both stocks and equity mutual funds. So, equity mutual funds refer to mutual funds that have an equity exposure of greater than 65%. So for stocks, you have a 1 year threshold before which the gain or loss will be considered short term, and above which the gain or loss will be considered long term. The short term capital gain tax on stocks and equity mutual funds is 15%. The long term capital gain tax on stocks and equity mutual funds is 10%, but gains up to 1 lakh rupees are exempt from long term capital gain taxation. Now, this is fair enough. This is simple enough for just as at a high level. But there are various different nuances that need to be factored in when you're computing your taxation for your capital gains for stocks and equity mutual funds. The first being the grandfathering clause, the long-term capital gain grandfathering clause. I think many of you are already aware of what this is. This was something that was introduced in 2018, but it basically means that gains before 31st January, gains before 1st April 2018 are exempt from long-term capital gain taxation, and any holdings that you hold after 1st April 2018 are subject to the grandfathering clause. And the way you go about this is that you grandfather the gains made on such assets by looking at the fair market value on 31st January 2018. So essentially what the grandfathering clause does is it exempts you from gains accrued up to 31st Jan 2018 on any assets that were sold after 1st April 2018, and only applies the 10% long-term capital gains after the grandfathering clause has been applied. So essentially what this does is you have to, for any assets that you're holding today that you bought before 31st Jan 2018, you need to see the fair market value on 31st January 2018 to see what the actual cost of acquisition of that asset is, and only then compute the capital gains accordingly. Even today, you might be holding assets that were in your portfolios in 2017, 2016, 2015, very long term in nature, and you have to make sure that the gains on those assets are properly grandfathered in accordance with the grandfathering clause. And this is something that MProfit properly handles. So I'll show you one example of how that happens. In this current portfolio here, I have Infosys. And when I click into Infosys, you can see that when I click all to date, you will see that the first buy transaction here is on 23rd August 2017. And the sale was in 1st October 2023. Now, when you compute the capital gains on this sale of Infosys, you have to make sure that the gains are grandfathered. They're not just simply, it's just not simply sale value versus purchase value that you have to use as the gain or the loss amount. And the way that has to be done is it has to factor in what the price of Infosys was on 31st January 2018. So I'll show you how MProfit does this in the capital gain report. So I will go to reports, and under capital gains, I will go to the capital gains ITR format report, and I'll click stocks here. I'll generate it for the last financial year because that's what we're looking at. And in the last financial year, you will see that the capital gain report has been generated. And in this report, you can see that Infosys has been booked. And you are seeing that even though the sale price was 1200, it looked at the fair market value of Infosys on 31st Jan 2018, which was 1166. And accordingly, it took the cost of acquisition as 1166, meaning that the gains you made between 31st Jan 2018 and the sale date, which is 1st October 2023, those gains are only factored in, and the gains before 31st Jan 2018 were grandfathered. So the purchase price was actually 860, but the cost of acquisition that needs to be accounted for capital gain purposes is 1166, because that was the fair market value on 2018. And that's what the grandfathering rule tells you, that you have to only look at the gains made after 31st Jan 2018. Any gains that were made prior to 31st Jan 2018 are grandfathered. and your purchase amount and the capital gain are calculated accordingly. So essentially, that's what the grandfathering rule does. It makes sure that you get the benefit before 31st Jan on whatever gains were booked before 31st Jan 2018, and any gains made after 31st Jan 2018 for assets sold after the financial year 2019 and beyond, those gains are subject to a 10% long-term capital gain. So that's one big nuance that needs to be handled in your capital gains reports. And the good news is, if you're using MProfit, then regardless of when your assets were bought and sold, if you are importing the contract notes properly into MProfit, if your trades are properly accounted for, your grandfathering of capital gains will be handled automatically by MProfit. There's no need for you to do any manual work in figuring out what the fair market values were on 31st Jan 2018. See, this is many years ago already. So, it's not something that we want you to be worried about today, but it still holds today for assets held in the long term. Anything held before 2018, you still need to make sure that your gains are grandfathered, and this is for your own benefit. Otherwise, you'll end up paying a 10% tax on any gains that you hold for assets that were even purchased in 2007, 2008, 2010. And this benefit needs to be handled. And that is why it is important for you to generate your capital gain report accurately. So that is the grandfathering benefit from an MProfit perspective. Then another thing that needs to be handled are corporate actions. Now, what are corporate actions? Corporate actions are, your splits, bonus, demerger, merger, dividends. These are corporate actions that are applicable to and declared on your stocks that are held in your portfolio. And anytime you're holding a stock and a corporate action is declared on the record date, you need to make sure that the corporate action is properly factored, and that actually affects a variety of different things. It affects your capital gains, it affects your XIRR, and I don't know if everyone knows here, but MProfit properly handles the application of capital gains and adjusts your holdings, your capital gains, and your XIRR accordingly. So, for example, I'll just tell you how MProfit actually computes accounts for corporate actions. We have a very simple automation for corporate actions for any family that you're in. You can quickly click actions and click auto corporate actions here, and you can apply corporate actions from 1st April 2016 for the entire family. So if you are holding multiple different portfolios within MProfit, we've explained this on previous webinars, but we have an automated corporate action process that can apply all the splits, bonuses, mergers, demergers, and dividends on your family or on your portfolio across all your stock holdings from 1st April 2016 until present date. And when you click the apply button, it will apply all the corporate actions for you, even for holdings that are not currently in your portfolio but were there at some point. So if you have exited a position entirely, but from a taxation perspective, if a corporate action like a split or a bonus does impact the capital gain, you will need to make sure that the corporate action is handled. So oftentimes your CA would do this manually, or you would do this manually, or your CA who's using MProfit would want to do this. MProfit is here to automate these things for you, so that you don't need to worry about how to manually account for corporate actions, especially for people who use Excel sheets to manage their portfolios right now. I'm sure many of you are aware how complicated it can be to properly account for capital gains and adjust your transactions accordingly. So MProfit provides this benefit where everything is automated just with a couple of clicks when it comes to corporate actions. And once corporate actions are accounted for, it actually also affects your capital gains. So I'll give you an example here. So if I'll go to HDFC Bank, or in HDFC Bank, if I go to all to date, everyone knows there was a merger of HDFC Bank and HDFC Limited. Now that merger made sure that the HDFC Limited is merged into HDFC Bank. That impacts your capital gains. How does that impact your capital gains? So if I go now and I go to preferences and I show the zero holdings, you will see that HDFC Limited has come back into my zero holdings. I'm not holding it anymore because it was merged into HDFC Bank. But when I go into HDFC Limited, you will see that I had bought it on 10th March 2023 at a specific price. Now it was merged into HDFC Bank. And now when I go back and I generate my capital gain report, which I previously showed you, I'm going to just generate it again. So in the capital gain report, you will see that HDFC Bank had a short-term implication here, and this is accounts for not just the cost of acquisition of the actual HDFC Bank shares, it also takes into account the original purchase price of the HDFC Limited shares that were merged into HDFC Bank. So both aspects need to be accounted for properly when you are computing your capital gains on HDFC Bank. Any asset that was merged into another asset, the actual cost of acquisition and the purchase date both need to be factored in. And MProfit properly handles it for mergers. Similarly, I'll also show you an example of a demerger here. So for demergers, the most well-known example is obviously Reliance Industries. And Reliance Industries demerged into Reliance Industries and Geo Financial Services with a cost of acquisition ratio of 95.32% to 4.68%. Now, what that means is that after the demerger happened, the cost of acquisition ratio needs to be used to bring down the cost of acquisition proportionately for the adjusted holding of Reliance Industries and the new holding of Geo Financial Services. So 95.32% has to be of the original purchase price. So this 6.3 lakh rupee amount, 95.32% will be adjusted after the demerger to Reliance Industries. So that adjustment makes the adjusted cost of acquisition of Reliance equal to 6 lakh rupees in this case. And for Geo Financial Services, which I currently don't hold, in this example, I have shown a sale. The adjusted value, 4.68% of that original holding of 6.3 lakh rupees is the adjusted holding is 30,000 rupees in this case. Now, why is this important? This is important because when I go back to my capital gain reports and I generate the capital gain report to see my capital gain for Reliance Industries, you will see, and for Geo Financial Services, you will see that the cost of acquisition ratio needs to be properly accounted for to provide you the actual cost of acquisition in the capital gain report. So here you can see Reliance Industries, the adjusted purchase price was 2000, and Geo Financial, the adjusted purchase price was 98.28, vis-a-vis what the original purchase price was of my Reliance Industries shares before the demerger. So the demergers are a little more complicated, and we've often seen that brokers also are not being able to provide the cost of acquisition analysis properly while providing the capital gains in the capital gain reports. So sometimes people do come to us saying that my cost of acquisition, my capital gain is not matching with the broker for a specific security. Very often we have seen that demergers are the reason why MProfit is properly able to handle demergers with the cost of acquisition. So we actually find the cost of acquisitions from the circulars that the companies release, and we actually provide the adjusted corporate action. We provide the corporate actions that adjust your cost of acquisition accordingly. And this is something which is very important when you're computing your capital gains. People often say that what is the difference between brokers' capital gain report and MProfit's capital gain reports? Many brokers might be doing it correctly, but there still are cases where we are seeing where brokers are not being able to handle this, but MProfit is, and we are able to provide you the accurate capital gains for demerged securities as well. And not just demergers. This is just mergers and demergers. We go beyond mergers, demergers to bonus splits as well. So regardless of which of these four corporate actions impact your capital gains, MProfit, if you are handling the capital, if you are applying the corporate actions using the automation and you are, adjusting your holdings properly, you will see that MProfit's capital gains are properly handling this. And one more thing to note is that MProfit uses the first in first out rule, which is an industry standard. You can use the first in first out rule to compute your capital gains. So any security that is, any transactions that are bought first are sold first. Simply put, that is how MProfit uses FIFO, or first in first out, to compute your capital gains. So that covers corporate actions. Beyond corporate actions, there are a couple of other nuances also. Number one being, and we get this question a lot, are buybacks subject to taxation? No, buyback gains are not subject to taxation after 5th July 2019. So any buybacks that were announced after 5th July 2019 are not subject to buyback taxation. And which is why those transactions will not come in your generic capital gain report. But we in MProfit do provide a report for your buyback capital gains. And this is just for to show you what gains and losses were made from buybacks. And these don't have to be filed for taxation, but we provide you a report. If you go to, so I'll just show this again once. If you go to capital gains, you go to stocks, and then you go to the advanced options here and you click on only buyback gain loss after 5th July 2019. You generate this report only. What you will see is you will see the buyback, only you will see the buyback transactions and the gain and loss for those transactions. So in this case, you are seeing TCS and Somani Cements as two different buyback transactions. Only these two transactions have been accounted for. And this is just as an FYI to you that these transactions are not subject to capital gains. So this is how MProfit handles buybacks. Oftentimes, if a buyback is coming as a regular sell in a contract note without any indication that it is a buyback, and it is getting imported under MProfit as a sell, then obviously that will count as a regular sell. But if you want to account for a buyback transaction separately, you can click on any asset, you can click on other transactions and add it as an off-market buyback transaction. If the transaction type is buyback, it will definitely be handled as a buyback. And now we're also started supporting buyback contract notes. So if you have a buyback contract note coming separately and that is being imported separately, then we are able to properly handle the buyback capital gains and not provide it under your general capital gain report. So I hope that is clear on the buyback front. The next thing for stocks and equity mutual funds, the one rule that has been changed recently, and we've talked about it in a previous webinar, but I'll cover it once again, is the bonus stripping rule. The bonus stripping rule has changed recently such that if an investor purchases shares within 3 months before the record date of a bonus issue and subsequently sells any or all of those original shares within 9 months after the record date, any losses that were incurred during the sale will not be considered while computing capital gains. Previously, what was allowed is that if you were able to book a loss on shares that were bought within 3 months of the record date of a bonus, you could offset them against long-term capital gains that you made on that asset in the future. It was a very well-used strategy, but that rule has changed from the last financial year, such that any bonuses, any losses on incurred using this bonus stripping strategy will now no longer be allowed to offset any capital gains. And I can quickly show you an example of that also. In all cargo logistics here, a bonus was issued on the 2nd of January 2024. And for this example, we have a buy or within a 3-month period, which is 1st December 2023. Now, if I have sold that asset on 10th February 2024, which is within the 9-month period after the bonus, it does accrue a certain loss. You can see that the buy price was 70, the sell price was 68. So obviously per share, there's a 2 rupee loss. Now, when I go to reports and I open the capital gain report here again, what you will see is you will see that the capital gain here is not showing a loss. It will show as 0. And that is because, sorry, this is, again, I need to just change the setting here to open the general report. So all cargo logistics, as you can see in this report, the capital gain is 0. And the capital gain is 0 because we are not allowed to book a loss on this sale. So the purchase price is reflected as 68 only, even though the original purchase price was 70. And what happens is that the loss amount is then allocated as the purchase price of the bonus shares. That's how you are able to use the new implications around bonus stripping. So MProfit properly handles the bonus stripping rule also. So you don't need to do any manual work on this. So recapping once again, for stocks and equity mutual funds, your long-term capital gain grandfathering clause your corporate actions, buyback, gains and losses, and bonus stripping. Four key nuances are handled automatically by MProfit. You don't need to do the work manually to adjust or account for anything. As long as you've imported your transactions and you've applied the corporate actions, this will be handled properly. So I'm going to move on to the next slide now, which is the debt mutual funds. Now, debt mutual funds have undergone a few changes, as you know. So the differentiation comes around mutual funds that were purchased before 1st April 2023 and after 1st April 2023. Before 1st April 2023, there was both a short-term and a long-term benefit on debt mutual funds. So the short-term capital gain implication was if any debt mutual funds that held less than 65% equity, or were international funds, or were fund of funds, or were gold and silver funds, the tax category assigned to them was debt, and with under 3 years, they were subject to a short-term capital gain tax, and that was just taxed as per your income tax slab rate. That is added simply to your income and taxed as per your slab rate. Over 3 years, you were allowed a long-term capital gain benefit, 20% with indexation. So what this means is if you purchased a debt mutual fund before 1st April 2023. So now I wouldn't say just a debt mutual fund. If I purchased a mutual fund that had a tax category implication of debt, meaning that less than 65% equity exposure, or international fund, or fund of fund, or gold and silver funds, they got a tax categorization of debt. And if you held them for more than 3 years, you would pay a 20% long-term capital gain tax on that particular asset after selling it after 3 years. So basically means that if you have any transactions, if you have any holdings that fall under this category, they were purchased before 1st April 2023, and if you sold them in the last financial year, then this is the capital gain implication for you. The rule change has happened after 1st April 2023. What has happened after 1st April 2023? A new concept of debt versus hybrid has been introduced. So now the tax category of debt for purchases after 1st April 2023, the tax category of debt is for mutual funds that have an equity exposure of less than 35%, or international funds, or fund of funds, or gold and silver funds. The differentiation comes when you have mutual funds that have equity exposure of more than 35 but less than 65%. So debt funds that get categorization of debt purchased after 1st April 2023, they only have a short term, they do not have a long term benefit. Gains are taxed as per your income tax slab, regardless of when you sell them. So for any fund holding less than 35% equity, if you are purchasing them after 1st April 2023, please note that you will not get any long-term benefit, long-term capital gain benefit on those funds. Those gains will only be added to your income and taxed as per your income tax slab rate. But if you buy funds after 1st April 2023, if you bought funds in the last financial year that have an equity exposure of between 35 and 65%, they get a tax categorization now of hybrid. And what the hybrid category does is it still retains the original long-term benefit. The original long-term benefit gives you 20% long-term capital gain tax for those funds that are held 3 years and higher. If they are held less than 3 years, you are still taxed as per, they are still added to your income and taxed as per your income tax slab rate. If they are held more than 3 years, you still get the 20% benefit with indexation. And now I'll just take a second to again clarify what indexation is. The indexation benefit is simply, it refers to the adjustment of the purchase price of an asset for inflation using the cost inflation index. And this basically allows you to reduce the capital gain liability in line with indexation, in line with inflation, while selling any asset, such as mutual funds, for example, or bonds. So you can use the latest CII number, which has been announced for the last financial year as well. And MProfit properly handles that automatically, so you don't need to worry about it. but basically it just means that your cost price for any asset will be adjusted in line with inflation to provide you the indexation benefit. So for any gains in mutual funds that you are allowed the indexation benefit, those the purchase price of those funds are properly handled in line with the latest CII numbers, and any funds that you hold where a long-term benefit is not applied, your gains will be taxed as per your income tax slab rate and added to your income. MProfit now, and since the last few months, we've already started supporting the new changes to mutual fund taxation. So for equity mutual funds, nothing changes. It is still greater than 65%. It gets the same implication as stocks. But for debt and hybrid, now you can see that you can generate the debt and hybrid report for mutual funds. And when you generate it, you will see that mutual funds that get the debt categorization from a tax standpoint will be provided under debt, and mutual funds that get the hybrid categorization will get the long-term capital gain benefit if held for 3 years and higher. So in this case, I only have one example here, but I'll just show you a sample report once. So as you can see, again, this is again only a stocks report, but basically to give you to just summarize, MProfit properly handles taxation on debt mutual funds, and you don't need to do any figuring out yourself of whether a mutual fund is hybrid, whether a mutual fund is debt. MProfit tracks your purchases before 1st April 2023, after 1st April 2023, and accounts for each purchase accordingly and gives the right tax treatment as per the income tax guidelines. So you don't need to do any manual work there. Once you have used the MFCAS API to import your mutual funds from MF Central, you can simply generate your capital gain report by clicking here, and you will get the right tax treatment for any financial year that you're looking for. So this is a little complex in terms of understanding what is long-term, what is short-term, what is hybrid, what is debt. But overall, this is automatically handled in MProfit. So that covers your mutual funds as a category. So now after this, I will move on to the next slide, which goes to bonds, sovereign gold bonds and traded bonds. So MProfit, as you know, allows you to import your sovereign gold bond transactions and your traded bond transactions. And you can definitely track those holdings in MProfit in real time. We provide daily prices for these assets, and we also provide detailed capital gain reports. Excuse me. So I'll first talk about sovereign gold bonds here. So in sovereign gold bonds, you have both short-term and long-term capital gains. The holding implication is a 3-year. If it's sold before 3 years, again, added to your income, taxed as per your income tax slab rate. If you hold a sovereign gold bond greater than 3 years, you get a 20% benefit with indexation. You get 10% if indexation is not availed. So 20% is the tax rate if indexation is availed, and 10% if it is not availed. If you hold a sovereign gold bond until maturity for up to 8 years, then those bonds are exempt from capital gain taxes. That is essentially the rules for a sovereign gold bond. Moving on, traded bonds. For traded bonds here, the holding implication is 1 year. If you hold it for less than 1 year, the capital gain implication is it's basically just added to your income and taxed as per your income tax slab rate. If you hold it for greater than 1 year, it's a 10% benefit without a 10% taxation rate without indexation benefit. So that's quite simple also. So both sovereign gold bonds and traded bonds supported in MProfit, but the capital gain implication is different for both. The holding period implication also is different for both. So we provide one report here called traded bond report. You will get the capital gains for both the traded bonds and the sovereign gold bonds under one report itself. And I'm just generating a sample report to show you. So here you can see that there are a couple of traded bonds here and there are a couple of sovereign gold bonds here. These bonds, because they are held for less than 3 years, they have a short-term capital gain implication. And these bonds are held, these are regular traded bonds, not sovereign gold bonds. They are held for greater than 1 year. So they are getting the long-term capital gain benefit. So you can generate this report for your bonds from MProfit and give it to your CA or upload it to a tax filing portal as per your requirement. This covers both traded and sovereign gold bonds. So that covers bonds as a category. And I will move on now to REITs and InvITs. That's obviously a new age asset class getting more prominent right now. In fact, REITs have gotten quite popular among investors from what we are seeing. So, we have supported a report for REITs and InvITs as well. You can generate a report in MProfit that provides you capital gains for REITs and InvITs. Now, what is the taxation implications here? Holding period again is 3 years. If it is held for less than 3 years, it's a 15% short-term capital gain tax. If you hold a REIT or InvIT for greater than 3 years, it is a 10% long-term capital gain tax. But again, like stocks, capital gains up to 1 lakh rupees are exempt from taxation. So basically, this is quite straightforward from a capital gain taxation standpoint. You can generate a REIT and InvIT report in MProfit, and that will give you the accurate long-term and short-term capital gains for REITs and InvITs as well. So here you can see we have a few sample REITs in this portfolio, and you are getting the short-term capital gain here. I'm sure that for most of you, long-term capital gain implications for REITs and InvITs will kick in after 3 years of holding them, because these are fairly newer assets. So that covers REITs and InvITs and brings us to the end of the overall investment level taxation implications. What we'll do now is we'll quickly talk about futures and options as well, because as you know, MProfit also allows you to manage FNO portfolios, track your FNO positions, get P&L reports in FNO, also get turnover reports in FNO, and these are two reports which are required for you. From a year-end perspective, you need to submit the turnover report and you need to submit the your P&L report, because you need to know what your P&L is. So I'll just quickly show you exactly how these reports look like. You can go to an FNO portfolio and MProfit. If you've imported your contract notes or your transactions, you will see the positions open on your summary screen. But you can go to reports. You can go to P&L summary. So we have two types of P&L reports. One is a summary report, which gives you overall at the instrument level P&L. It gives you the quantity sold, sale amount, purchase amount, and the realized P&L of your FNO positions. And you also have a transaction-wise P&L report, which gives you transaction-wise P&L for your FNO instruments. And that is obviously more relevant to many of you from a year-end perspective. So this is the report you can use to generate your transaction-wise P&L for FNO. We provide FNO support for equity FNO, for commodities and currency as well. So here you can see there are some currency FNO as well. So you can get the accurate P&L transaction wise on those assets too. And then we obviously provide the turnover report also. It gives you a detailed FNO script wise turnover. And I'm just opening this report for you. I hope it's visible on the screen. So you can see that there's an FNO turnover report as well. You get the instrument name, quantity sold, sale amount, purchase amount, the realized profit and loss, and the turnover. So this is also provided in MProfit. So that, in a nutshell, covers FNO. And obviously, in the future, we will do a more detailed FNO webinar also. So that is FNO. Then one last thing I want to talk about is your unrealized capital gain reports. So, in addition to realized capital gain reports, we also provide unrealized capital gain reports, which give you a notional P&L on any unsold assets. So if you have a current portfolio with a set of assets that are not sold, and for tax harvesting purposes, for example, you want to see what the capital gain implications will be if you sell those assets at current market prices, you can generate an unrealized capital gain report from MProfit, and you will be able to see what the capital gain would be at today's valuations. This was more important. I know we covered this before, I think in February we had a webinar on this. So we covered this then, where for tax harvesting, if you want a report to see how to optimize your capital gains, then you can generate this report and exactly understand what your unrealized capital gains and losses will be. So that covers your unrealized capital gains. And then we have the tax software formats. This is important right now for many of you who will be filing with various different softwares. So ClearTax, Winman, Computax, Spectrum, Genius, and Tax Pro. These are various different popular tax softwares that many of you use or your CAs use. Like Winman is a very popular tax software with CAs, which helps with end-to-end tax filing. And MProfit basically allows you to generate your capital gain reports in these formats. Once you have accounted for your transactions and are ready to generate your capital gains and export them out of MProfit, if you're using any of these tax software, what you can do is you can just simply generate a report in like from one of these portals. So ClearTax or Winman or Computax, you can just simply click stocks or mutual funds or equity or debt. You will be able to then get a report in a format that is compatible with that tax software. And all you need to do then is when you generate the report, you need to just copy the data from the generated MProfit report into the template that is uploadable into ClearTax or Winman or Computax. You cannot directly upload the report into those tax software for the reason being that ClearTax or Winman, they have a template with pre-filled formulas. So we allow you to directly copy the columns into that report, and that is quite simple. So that the formulas get automatically calculated when you copy the data from an MProfit capital gain report into the actual ClearTax template or the Winman template. But this will dramatically make your tax filing easy because you don't need to manually prepare that ClearTax report and then upload your P&L. You can export this out of MProfit, copy the data into the template provided by ClearTax or any of these other tax software, and then you can give it to your CA or do it yourself by going into the tax software itself on the online portal. And one more thing is we also provide the Schedule 112A report, which if you're using the government ITR portal, you can download this Schedule 112A ITR format report and again, copy it into the template, which is uploadable into the government ITR portal. But this will make life easy if you are using one of these other platforms to file your taxes. As you know, MProfit is not a tax filing portal. We provide you the capital gains from your investment transactions, and you take those capital gains forward to your tax filing software. So we've tried to automate that process where you need to manually prepare that capital gain report before you file your taxes with another portal. So we support all of these different software, and we'd be happy to support any more software also. Our clients have only requested some of these, and we've built the format. We built the tax software reporting formats based on client requests. So if you have any other popular software that you're using that you would like us to support, please do send us an email to support@mprofit.in, and we'd be happy to evaluate and see if it's possible. And yeah, I think that brings me to the end of today's webinar that we wanted to cover. Super thankful for all of you, consistently showing your support as we do the webinars, and we plan to restart more webinars now as we go forward. Thank you for also voting on the poll, and surprised that 100% of people who voted found the webinar useful. So really thankful and grateful for all of you, and thank you all so much. Look forward to seeing you all again at the next webinar. And please do share your questions and support queries with us if they were not answered in this webinar over support email support@mprofit.in. We'll try our level best to answer it. So thank you everyone once again. Thanks so much.